I'm Ernie Humphrey, Educational Programs Leader for Performative, the largest online community for corporate finance, accounting, treasury, and related professionals. I'd like to welcome everyone to today's webinar, Hiring, Paying, and Retaining Employees Across the Globe, Compliance and Best Practices. As your organization expands internationally, the complexity of your operations will increase, and the manner in which your company hires, pays, and retains your employees is critical to driving sustainable growth in international markets. Processing multinational payrolls, expatriate versus in-country staffing to engage and retain the right talent, paying employees on time, and complying with local regulations can leave room for error and lead to significant compliance and business risk exposures. Today we will discover the best practices and common pitfalls when planning for and executing your international staffing strategies. I would like to thank High Street Partners, whose commitment to thought leadership helps us make this webinar possible and delivered at no cost. A quick note on today's agenda. First, we'll hear a presentation from our featured speaker. Then we'll move to the interactive Q&A session where we will spend the remainder of our hour. We would like it to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in the GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our best, and we'll follow up afterwards on any questions we did not get to. A few logistical notes about the webinar today. A link to today's presentation and video recording of the webinar will be sent out to all attendees within 24 hours of the event. Those who would like CPE credits will need to answer all polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@performative.com. Those attendees who qualify for CPE credit will receive a CPE certificate for the webinar within 24 to 48 hours of the event. Again, we encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel at any time during the event. Finally, you'll be asked to take a short survey regarding the webinar today. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community resource for senior-level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face every day. Let's get started by introducing today's featured speaker, Katie Davies, Senior Director, High Street Partners. Katie oversees High Street Partners advisory client engagements across 5 continents. She is an expert in a wide variety of cross-border issues, including HR, tax, IP, and immigration consulting. Katie also provides hands-on client services to many of the firm's U.S.-based accounts with operations in Europe. With that, it is my distinct pleasure to hand the floor over to Katie Davies. Katie, the floor is yours. Please take it away.
Thank you, Ernie, and good morning, everyone, and thank you for joining this webinar. So I'm just going to start, although this session is all around HR practices and pay, reward, and retaining employees, I think it's important when you're looking in the international context to start around company structure. And the reason I say that, company structure matters. It matters for a whole host of reasons, and in the HR context, it will dictate, to some extent, your market presence and your perception in the market when you're looking to hire and recruit and potentially retain employees. The type of entity that you set up in territory will also dictate the timeline that it takes to actually set up that entity, particularly if you're going into a new market or a new country. So it's important when you're looking in the international context around planning your expansion into territory well in advance if you're looking to hire and recruit employees for the first time. To give you some examples of that, in France, for example, if you register just a payroll-only type of entity, which we call an NRE, which is a non-resident employer, it can actually restrict the number of available providers from a benefits perspective that you can actually tap into. Equally, in the UK, for example, not having a local bank account available can limit your ability to set up things like direct debits with benefit providers. So the reason I'm mentioning company structure in the HR context is you have to look at these things in the round and comprehensively from an international hiring perspective. So when you're looking at corporate entity setup, the fundamental question that we have to ask ourselves is, do the activities of the employees that you're hiring in country create what's called a permanent establishment or a corporate tax nexus? The answer to that question, and I won't go into details today, will in turn dictate the type of entity that is appropriate. So if the answer to that question is no, there is no corporate tax nexus, then it may be possible to register just a payroll only or a representative office, which usually is quicker, simpler to set up and less costly. If the answer to that question is no, there is a corporate tax nexus, then invariably you're going to have to set up some form of subsidiary or branch office which has cost, it has timeline, and it will have ongoing compliance obligations that you need to factor into your budget and to your overall considerations when thinking about going international and operating internationally. So coming on to the focus of this webinar today, looking at international staffing profiles, we basically have a choice of three. We have local employees, that is local, typically local nationals, but basically people employed locally under local terms and conditions. We have the concept of expatriate employees or globally mobile employees. And then we have the third category of third-party independent contractors, which we'll come on and look at in detail. So for employees, whether they're expats or locals, it will be a requirement to run some form of local payroll, both in terms of considering paying net pay, but also in terms of reporting the salary, the remuneration for tax purposes, and complying with local payroll regulations. In the expatriate context, we have many, many different issues to consider, but the key one that I want everyone to take away from this call is immigration and visa has to be your #1 focus and priority, and you'd be surprised the number of customers and clients that I talk to who have illegal foreign nationals, mainly US citizens, working particularly in Europe because they didn't know that they required a work permit or a visa. And that can create problems when that senior person gets turned away at the customs border through inappropriate work permits. And then when we look at the contractor position, we have to really ask ourselves, are we trying to bend the rules? Are they really a bona fide contractor, or are they a de facto employee? And we're going to look at each of those in a little bit more detail. The biggest mistake that I see working with many American customers is the assumption that whatever you do in the US will work in an overseas country. Unfortunately, life is not governed by US legislation. Every single country in the world will have its own compliance and legislative requirements, and they are unique to each country. So trying to force through things that you do in the US from an HR perspective just does not work. And failure to follow best practice at best results in dissatisfied employees. At worst, it can lead to litigation and total non-compliance from an HR, payroll, and tax perspective. The key message is everything is different overseas, and although that sounds, I hope, not patronizing, it's not intended to mean patronizing, it amazes me to this day that I talk to many, many US customers who really don't understand the fact that international operations is very different from the US practices. So here is an example of high level of a US offer letter, obviously in abridged version. It simply indicates heads of terms, is how I like to think about it. It's fairly simplistic. It details basically what the individual is going to receive by way of salary, some reference to paid time off, company share-based options, and the fact that the employment is at will. US offer letters are very simplistic. And when you start looking at other countries, a more formal and more detailed employment contract is typical. And those contracts will invariably be longer, more detailed, and have much more content, legal content in them. The concept of employment at will, the ease at which you fire somebody or terminate someone from your business, is not a concept that is common in any other country outside of the US. And this is one of the key areas that gets brought up time and time again when we look at international hiring. Each country that you have employees working will have its own set of employment laws and employment legislation. And things like notice periods and how you terminate someone will be dictated on a country-by-country and potentially state-by-state, canton-by-canton basis. And it's really important that you understand those rules and regulations before considering employment in the international context. The employment contract should be designed not just to cover the statutory minimum, but also to embrace best practice, to show that your employees, who are, after all, expensive resources for you, that you understand the local environment and that you're not just a naive employer that really doesn't have a clue. So this is why, again, upfront planning is important, so that you demonstrate credibility to your international workforce. Just to give an example of this, in Germany, if you include a post-termination restriction in the employment contract, you will typically have to pay something like 50% of the monthly salary to the employee during that post-termination restriction in order to make that enforceable. I see many customers who decide, well, we'll put it in for a deterrent just to stop bad behavior post-termination. And actually, once you've got that clause in the employment contract, it's actually hard to revoke that clause without mutual consent, which can leave you, even if you decide to waiver the post-termination restrictions to the employee could actually turn around and say, no, I'm not prepared to waiver it. I want my money. I want 50% remuneration for the period as specified in the employment terms. That is just one small example of where points of detail can get caught up when you're trying to translate US practices into international employment law. And the important thing is that whilst a US offer letter is a relatively simplistic document, it will typically be supported by a range of appendices such as non-disclosure agreements and post-termination restrictions. And it's important to understand that it's not acceptable just to stick those appendices on the back of an international employment contract. Those appendices will normally be incorporated into the main body of the international employment contract, and the terminology that you use in those appendices typically will be riddled with things and references to employment at will. And again, those kind of concepts, have to be adjusted for local employment law. All of that goes to say that a US offer letter plus appendices of what you're used to in the US won't work internationally. And it is important to take advice up front to make sure that you know what you're on the hook for and reflect it appropriately in the local employment contract. Whilst there may be no technical requirement to have an employment contract as such, usually there is some legal requirement to have written terms and conditions. And it's that written terms and conditions that manifests itself into a formal employment contract. So essentially, it's the same thing. However, if you don't have an employment contract for whatever reason, you need to be aware that local employment legislation will take precedence. So even if you decide to give them a US offer letter and the employee doesn't say anything, because they're working, let's say, in the UK or France or Germany, in cases of contention, local employment law will always override any other contractual commitment that you've made. So it is important that you do understand your statutory obligation. The other thing to be very well aware of, particularly in Europe, is that different industries will have different union agreements or collective bargaining agreements that can impact the applicability of the terms and conditions of employment. Further, different levels or categories of employees will also attract different treatments in terms of entitlement, benefits, and legal references that have to be included in the contract. By way of example, in France, there is a concept of cadre. Cadre is a management or executive level of employee, and they are treated very differently from your blue-collar workers or your more lowly paid employees. Things like minimum wage, mandatory overtime payments, etc., will be affected by the grade and seniority of employees. So not only do you have national law to contest with, and potentially that being affected by different states or cantons, you have to be mindful of which collective agreement or union agreement may apply to you, and that's not subject to you as the employer joining a union. It is just de facto the industry sector in which you work can simply make you subject to a collective agreement. You also have to consider the level and category and grade of the employees that you have working on your payroll. It all goes to add up to being quite a complex arrangement in certain countries, and the key ones to be aware of are places like Brazil, France, Spain, Italy, where they have highly protectionist regimes from an employment law perspective. Oftentimes, these countries will also have a local language requirement. In other words, the employment contract is actually enforceable only in the local language, and whilst we would typically provide an English translation to sit alongside the local language, it is the language of the local country that will typically apply, not the English translation. It's also key that you understand that any supplemental documentation, such as equity-based plans or share-based commission plans, non-disclosure agreements, or any other supplementary employment document, also have to be translated into the local language. These translations have to be done by a legal translator to ensure that the spirit and the intent of the English version is not missed. And the result of that is that these legal translation costs can be significant, particularly if you have to get a share award or a stock option type agreement translated into local language. Again, all of these things have to be factored into the considerations when you're planning your international expansion, because it affects the cost and the budget. It also affects the timeline for rolling out these documentations to employees. In terms of contractual commitments to employee benefits, it's important to understand that when you first set up in an international country, what you may do from an employee benefit perspective may actually change over time as you become more sophisticated, as you hire more people, and as you're able to secure better benefit terms with providers. The point of making that reference is the fact that it's important to maintain flexible language in any benefit clause that you put in your contract, such that you're not shooting yourself in the feet from the get-go in terms of overcommitting on employee benefits, which actually might be quite hard to implement, particularly when you're in startup mode and you don't have a credit history and you have no existing trading activity in country. And particularly where you have small numbers of employees, it means that obtaining good terms with these benefit providers is actually quite hard because you've got small numbers of employees, so you can't benefit from group insurance terms. So for example, I've seen contracts where a company will make a commitment to an employee to ensure that they are covered under private medical insurance. Unbeknown to that company, that employee had a pre-existing medical condition, which meant that no medical insurance provider would cover them or touch them with a barge pole, as we say in the UK. The result of that is that there is then some openness or interpretation that actually the employer is on the hook for those private insurance costs, which no other insurance company would actually underwrite. So it's key that the language when you commit to providing benefits is appropriately drafted, which means that it's subject to the ability of an insurance company to provide the insurance, and not that you are completely committing to provide that benefit. It's a subtlety, but it's important to kind of get this commerciality written into the contract to make sure you're not shooting yourselves in the feet. Next couple of slides really just highlight some examples for you relating to specific legislation, and we could be here for days if I went into too much detail. But in Mexico, for example, if you are paying a severance, it's basically 3 months of the final salary plus 20 days of salary for each day of service, and that is extended if you have someone who's worked for you for a long period of time. In Germany, there is mandatory supplemental health insurance, which complements the social insurance if the employee elects to opt out of the state health insurance system. So you, the employer, have an obligation to supplement that private health insurance at the employee's discretion if they so choose to opt out of the state system. In the UK, we have recently gone through a process of implementing new and quite rigorous pension legislation, which is being rolled out over a 2 to 3 year program, which actually has extensive administrative requirements, not from a payroll perspective, but from an HR management perspective. And we're still kind of getting our heads around exactly what that means for day-to-day HR administration. In the Netherlands, there is a nasty little provision which provides for the employer to pay for up to 2 years' worth of sickness leave at a rate of 70% of the daily wage, which is stated in 2012 at 191 euros per day, but that can add up over a 2 year period. And there are insurances that you can take out to cover yourselves against these liabilities, which until you, I have many customers who say to me, well, it's not going to happen, I'm going to save the insurance cost. And then, of course, a couple of months later, the employee calls in sick with a long-term illness, which could be depression or stress or back pain. And it's very hard to mitigate or litigate against having to pay this 70% of sickness pay. In Australia, there are mandatory superannuation, which is equivalent to pension, and the minimum contribution is 9% of salary. So again, all of these domestic requirements in country add to the overall cost of hiring, and when you're planning expansion, it's really important to factor these costs into your budget rather than letting your sales team say, hey, we've got great opportunity in, let's say, Australia, let's go hire 3 people. And we often get the phone call which says, we've hired these people, what do we have to do now in terms of paying them next month? And of course, the finance team are left holding the baby because they have no control over their costs, and really the sales team are calling the shots in terms of making these hires. So again, as soon as we can get in front of this thing and start planning for international expansion in terms of managing costs, it becomes a much more powerful tool. So again, just to reiterate, the legal requirements and the employee benefit programs will be significantly different than those found in the US. And this is further varied by having some detailed understanding of what the social security provisions are in each country. So for example, in France, an employer social security cost will be around 42% of salary. In Belgium, it's something like 33%. Those are significant add-ons to the salary cost of an employee. Now, because you're paying so much in social security, you would expect that the benefits that the employees receive from the social security system are rich, and indeed they are in countries like France and Belgium. I contrast that to somewhere like the US, where a combination of FICA and Medicare, it comes in around employer costs about 8%, roughly. But of course, what you get from the social security system in the US is much skinnier or thinner than somewhere like France or Belgium. Now, the relevance of understanding the social security regime is that it will then help shape and dictate what supplemental or best practice benefits over and on top of those social security insurances that are common and commonly provided to employees in a particular territory. So you don't just wade in and say, because we give pension, medical insurance, group term life insurance, short-term disability in the US, that we're going to roll out those benefit programs automatically in France, UK, Germany, etc., because you have to understand what they're going to get from the social security system. And this is further complicated by certain collective bargaining agreements or union agreements which actually impact some of the requirements in a particular territory and enhance the benefits that may be provided. Of course, in many countries, it is normal to supplement the social security system with discretionary benefits, but I would always recommend that local advice is taken as to what those benefit programs look like, so that you don't end up overcommitting and providing a package which is almost too rich for the particular territory. So just to give you an idea of some of the additional items, in the Netherlands, for example, it's very common to provide a company car to employees, as opposed to just providing a flat cash allowance via a car allowance. The reason for this is that it's tax efficient. And if you've had Dutch employees or even German employees, it's a frequent request to say, I want my company car, particularly if they're a sales guy on the road using their private car. Now, the problem that we have is particularly for companies who have just set up in territory or have very small numbers of people, there's an issue with the car leasing companies of actually getting credit, of actually having a trading footprint and having enough substance and trading activity to justify a commercial lease or a car lease in territory. So those are some of the practical problems that we face, and oftentimes the only solution is really just to go back to the car allowance but actually gross it up to take effect of the disadvantage from the tax impact. In Belgium, it's important to understand that on top of the 12-month salary, there is this concept of single and double holiday pay, which is referenced to 1.92 of the annual of the monthly salary. So effectively, in Belgium, you end up paying your total salary in 13.92 installments, and if you've set your annual salary at a maximum, you'll end up having to pay 1.92 months of salary on top of the salary that you think you're going to have to pay. And those are a pushback to the very socialist, protectionist systems that exist in some of these countries. And the same thing applies in Italy and in Spain. and some other Scandinavian countries. So again, it's important to understand the regime you're going into to understand whether holiday pay becomes relevant. So in recap on all that, it's important to understand the social security system. It's important to understand your statutory obligations in terms of employee benefits, but also other entitlements such as the holiday pay. Being sensitive and aware of language and culture to be able to retain employees in the first instance, to mitigate any employee discontentment because they're working with a US company that they may perceive doesn't understand the market, that you keep abreast of best practices and trends in that local international market, and understanding the perception of cash versus benefits versus equity. So it's common, particularly in the startup mode, to compensate employees in equity, stock options, restricted stock units, etc., and to skinny back on some of the cash rewards or the benefits. This is purely, obviously, to save cash flow in that sort of environment. However, in many countries, employees don't really regard equity as that strong an incentive because they really are used to receiving cash. And in some countries, such as Belgium and Australia, there are actually disadvantages from a tax perspective for the employee to be granted equity. They effectively get taxed on it at grant, which if you're in startup mode or in an entrepreneurial company where you're not quite sure what's going to happen to the options or the equity over time, that can be a big disincentive to actually take the equity or the options in the first instance. So we've seen pushback from employees saying, thanks very much for the equity, but we're not interested, we'd rather have cash. So again, understanding the local market and the balance of these items is key. Don't just go in and offer the same benefits that you're used to in the US because it's invariably going to be inappropriate for the local market. And I would strongly recommend benchmarking against your industry, job profiles, and the type of level and category of employees that you have in a particular industry. The reason we do all that is it's important to retain employees, and they need to feel engaged, and the fact that the US headquarters understands their market. And it's important from a finance perspective to ensure that your budget and your costing analysis is accurate as possible. The other side of this is that most of these benefit programs will require good HR administrative infrastructure to successfully implement, roll out, communicate with the employees, and then maintain ongoing management. And actually the initial phase of actually identifying what benefits to provide and setting them up is the easy part. The difficult part is then maintaining those benefit programs, adding new hires, make sure that the terminated employees are removed from the benefit programs, adjusting coverage for an increase in family size, etc. And what we find is many US companies, whilst they kind of get the setup right, the implementation, the ongoing administration falls between payroll and HR administration, and no one's really looking at it. So we often get gaps in maintaining benefit programs, particularly pensions, where there are pay rises that need to be factored into the pension contribution. Turning quickly to the concept of contractor. In the US, you will be well aware of the argument between an employee and a contractor. What makes an employee, what makes a contractor? And these arguments are generally internationally recognized tests to prove that you have a bona fide contractor. So tests like, are they free to work for other companies or institutions? Do they have to provide their services exclusively for you for a period of time? Do they hold themselves out as representatives of the company? Do they hold business cards in the name of your company? Do they have a right of substitution? Can they replace themselves with an alternative contractor? Do they use their own equipment, or do you provide them with their equipment? Do they receive employee benefits or other remuneration which is typically provided to employees? The answer to those questions, which I'm sure you can answer directly yourselves, obviously the more they look and feel like an employee because they hold themselves out as a representative of your company, they hold business cards, they receive employee-related benefits, the closer the argument is that even though you have a contractor agreement in place, in reality the facts of the case mean that they are a de facto employee. So it's important that you look yourselves in the eyes and say, are we using our contractor arrangements just to mitigate employment relationships and payroll obligations in country, or are they genuine bona fide contractors? And oftentimes we'll inherit a contractor population because that's seen as the easy way to get going in country, and trying to convert contractors into employees can be problematic because the contractor will typically be in a better tax position personally as a contractor than as an employee, so they'll often try to argue for some form of enhanced package over and above the contractor fees that they've been used to receiving. So just to summarize at a very high level some of the benefits and the risks of a contractor, as I alluded to, a contractor can hit the ground running. Typically there's no startup timeline. It's an easy way to get someone on the ground operating commercially for you without the timeline required to physically set up a payroll or a local entity. And it means that ideal candidates don't go cold on you because you want to retain them quickly, but that of course presumes that they are happy to render their services as a contractor as opposed to an employee. And if you are trying to hire and recruit people from well-established employment relationships, that can be quite scary for them, having to go out on their own as a contractor. The risks, of course, are that either the authorities or the employee or the contractor in time will try to argue that really it was a foil to cover up the true nature of the relationship, which was that of an employment relationship. And as a result of which, the employee has missed out of employment protection, statutory employment benefits, social security, and other protections that they would get if they had been an employee. And this can lead to individual litigation against the company, and of course, as a result of which, they can whistleblow you to the authorities, both in terms of employment authorities and the tax authorities, because the employer has effectively been defaulting on their employment obligations. The other downside is that the individual will also have to take care of their own accounting, paying their own taxes and paying their own social security, which can add a burden to somebody who's not necessarily used to doing that task. Just a little example, we had a contractor down in Colombia who was working perfectly happily for 5 years with the company, and then the company fell into economic difficulties. Effectively it was redundancy, and they needed to terminate the contractor relationship due to economic reasons. The contractor went to the labour courts and claimed that of course she was an employee and that the facts of the case stood up. She would use those tests that we've just run through, and the test proved that actually she was effectively a de facto employee, the result of which was that the company had to go back and accrue and pay out vacation time, 13-month paychecks, and obviously was penalized because they failed to account for payroll taxes, social security, and comply with their employment obligations in country. So it became a very costly exercise, not just in terms of professional fees to sort it out, but also the penalties that they then had to pay to the tax authorities, as well as the extra payments that they had to pay to the contractor to basically pay her off.
Thank you very much for that great content and your insights, Katie. I've gone ahead and launch our first polling question. Our first polling question asks you to identify the top opportunity for global expansion for your company in 2014. As a reminder, those of you after CPE credits for today's webinar need to answer all 3 polling questions during the webinar. Of course, we appreciate everyone's consideration in answering our polling questions. Just to note, we'll only have the polling question up for 45 seconds to a minute in order to get the best use out of our time. We hope this polling question will inspire your questions. And again, we encourage you to please ask questions on today's topic via the questions box in your GoToWebinar control panel. So I'm going to go ahead and leave this polling question up another 5 seconds or so, and then I will go ahead and get back to the great content that Katie is going to deliver to us. Okay, I'd like to hand the floor back over to Katie. Katie, please take it away.
Thank you, Ernie. So we're now going to turn to the big topic of expatriates, which is close and dear to my own heart. I started life at PricewaterhouseCoopers for 12 years in the expatriate tax practice. So managing expats, the reason that you may decide not to go down the local hire or contractor route or to mix expats into the local hire population is because expats typically will have worked at head office. They will have a good understanding of the products and services of your headquarters operations, and they can basically hit the ground running in commercial terms. so they can launch, and they're a great launch pad for your business in the international market. They're also a great ambassador for the company in terms of sharing culture and value and the goals to a newly hired local hire population who can, quite frankly, feel cut off and alienated from the headquarters unless lots of people come out and visit them from time to time. So the issue, though, with expats is they tend to be quite costly, and there are many, many different considerations that you have to think about when you think about sending an employee overseas. One of those areas is around taxation, and the other is around immigration, which I alluded to earlier on. Now, when you send an expat overseas, you typically have to design a compensation package for them which addresses not only issues such as relocation costs, cost of living adjustments, housing costs, spousal support, but also takes into account the fact that they're going to be paying taxes, income taxes, in the overseas country if they establish tax residency in that overseas country. And the result of that is that their net income tax position can be significantly different from what they're used to taking home in their paychecks in the US. So one of the things that's important to understand is, does the expat trigger a tax liability in the overseas country? And if so, what does this mean in terms of the impact on their net pay? And what is the company going to do? And yes, I say it's the company going to do to actually protect or equalize that expat in terms of their tax position. And the reason it becomes a company issue is because if you are going to take a hit of 20% to your net pay, would you take an international assignment? And in most cases, people would say, no way. So that can produce a barrier to global mobility if you don't address proactively the tax impact of personal income taxes when you send expats overseas. So when thinking about an expatriate assignment or the structure, there's some sort of key considerations that you need to think about are: how long are you going to send the expat overseas for? Is it a one-way ticket, or is it a short-term 2 to 3 year type arrangement with the intent to repatriate back to the home country? Is it a permanent transfer? Which is the host country? Is it a country in Africa or Asia, or is it a European country? Because that can dictate the sorts of things that you bake into the expat package, such as hardship allowances, if it's a location that's actually regarded as a hardship location, versus a country where actually you think the expat might have a great time and is going to really enjoy being based. The sorts of liabilities that you need to think about, obviously, are exposure to local employment law, and how does that fit with the domestic HQ employment law, let's say the US employment law. Is there any exposure to the company from their activities? I go back to that corporate tax nexus or the permanent establishment arguments that I referred to in the first opening slide, particularly if you don't already have some form of entity in the overseas location. And of course, the personal tax impact, both in income taxes but also social insurance taxes. What does that relocation mean in terms of the impact to the individual for those items? So, running through some key issues and mistakes, the 8 common mistakes. Immigration. You must think about the work permit and the immigration well in advance of sending the expat overseas. It will usually take some considerable time to get a work permit through, typically anything from 2 to 3 months, depending on the country. And in the UK, that can be much more extended. It can be up to 6 months to get appropriate work permit, depending on your structure and your setup. So when I have a client that calls me and says, I've got an expat who's coming over next week, we need to get a work permit, that really doesn't work. And then they say, well, what's the workaround? Well, the answer is the workaround is usually an illegal answer, which I can't obviously advise on. So getting the immigration piece squared away well in advance is key. The other misconceptions are the lack of understanding of the complexity of handling expats and unrealistic timings, as I mentioned, particularly on immigration, but also in terms of actually structuring the assignment letter and structuring the package, because this is a negotiation with the individual. They're human beings, and they're going to be uprooting their lives to go overseas. So they're going to want to think about the offer and the package that's being presented to them And from a company perspective, you're going to want to run some cost analysis to understand what's market practice, what are the things that I have to pay for, what are the things that I can get away negotiating on, and obviously understanding the tax and the social insurance side of things. A common misconception is, well, if I continue to pay my expats on the US payroll, that's okay, isn't it? It means I can avoid any host country or overseas country income taxes. And the answer is absolutely not. It is not a defense to say that just because you pay someone from one country that they mitigate or avoid income taxes arising in another country. And that's further compounded where I see arrangements such as split payrolls, which means that you have one payroll paying, say, 50% of salary in the US and paying 50% salary in the local country. Invariably, only local country taxes are subjected to the salary that's actually being run through that local country, and all the tax payments on the US paid salary are not reported and are not subject to local income tax, which is illegal and it's wrong. So I think understanding the payroll arrangements is absolutely key, and it's not simple, and it does need planning. Good HR records, having a good handle on your expatriate population, and I don't just mean formal expats who are going on assignment for 2 to 3 years. It's people who are on short-term commuter assignments, who are going in and out of countries for a week at a time and coming back home for 2 weeks and then going back out for, say, 3 weeks. We call it the 183-day drift. The reason that 183 days is relevant is 183 days is 6 months. And in most double tax treaties between the US and other countries, the relevant trigger for triggering overseas tax residency or tax liability is 6 months or 183 days in a 12-month period. So the point here is that you have to have good HR systems to track and to administer and maintain records with respect to your business visitors in and out of country. Another consideration from an accounting perspective is where do you actually book the expenses relating to the expat? Should they be booked in the US and not recharged to the local entity, or are they actually generating business and are they economically valuable to the local entity such that all costs should be recharged? One of the things that often happens, particularly in small expat assignments or expat numbers, is that the company just bows down to the demands of the expat because they just basically lose the will to live and the will to fight, and they just want, for commercial reasons, to get the expat over to the overseas country. The reason why that is bad is because if you then have a second expat, you begin to set precedents and you begin to have informal policies, and trust me, expats will go down the pub and they will share stories and they will compare their remuneration packages, and there will be discontentment if one expat is seen to be benefiting or is getting less package than the other expat. All that goes to show that you should really plan in advance to have some sort of policy so you can apply consistency and fairness to your expatriate population. And the last point is, whilst we may sit from an HR and a finance perspective and just impose our spreadsheets and our cost analysis on individuals, you have to remember that expats are human beings. Invariably, they're going to be uprooting their family connections, and there's going to be a lot of emotional turmoil, stress, particularly when you are relocating families. And one of the common causes, the most common causes of expatriate assignment failure is because the spouse of the expat is bored and dissatisfied in country. Because the expat goes off to work and is excited because they're in a new work environment, the spouse is stuck at home in an alien environment, typically without friends and colleagues, and it's really hard on that stay-at-home spouse. So again, understanding the complete dynamic of the family unit and anticipating that, counselling and mentoring the expat and the family before the assignment is key to ensuring that the assignment is a success and you don't throw money down the drain because they have to repatriate within a short period of time. Just in terms of summary, the two kind of considerations are the type of secondment. Is it a short-term assignment for less than 6 months? Is it a commuter arrangement? Are they whizzing backwards and forwards between countries? And that's when that 183-day drift becomes relevant. Is it a longer term assignment, potentially, let's say, 2 to 3 years? Or is it actually a one-way ticket? It's a one-way ticket to a new country, and if that's the case, then it probably doesn't form part of an expat assignment. It probably becomes a one-way relocation, and you're actually transferring that employee onto local terms and conditions. And then the second part of that is, how long is the assignment for? Is it less than 6 months, 6 to 12 months, 12 to 36 months, i.e. 3 years, or after 3 years, typically we'd be looking at permanent transfers. The reason that those items are important is that if you have expatriates crossing over those different categories, one thing to think about is putting together a global mobility framework, which is like a decision tree or a matrix of different policy decisions that cross around compensation package, remuneration, relocation assistance, tax treatments and tax support in a matrix format, so that you've got a consistent approach and a policy working document that you can then slot your expat into to make the management of the expat program that much simpler. This is just an example, and I'm not going to spend any time because time is short, of the different considerations around tax, social security, the payroll pieces, the decisions around whether you keep them on a host or a home country payroll with a split payroll arrangement, policy decisions such as what items get baked into the relocation package, etc., and other considerations, i.e. planning in advance, the costing, the budgeting of it, the psychological effects, whether the employee is actually going to fit in the culture of the overseas country, and also, importantly, what you're going to do in terms of repatriation. So that's just a sample of the kind of thoughts that need to go into thinking about expatriate planning. The final part of this webinar really focuses on global payroll. And again, it's to reiterate the point that when you're thinking about global payroll, we're talking here about local hires and potentially expats, but really mainly local hires, and understanding that what you do in payroll terms in the US is going to be very different from how you run your international payroll. Key considerations is, what do we have to report? When do we have to report it, and how do we report it? Are there online systems that we're obliged to use due to local country compliance requirements? Is there a requirement to pass through equity in the payroll upon grant? Do we have to make notifications when we grant equity? So payroll should be a relatively straightforward concept, but when you start layering in the different elements of things that go through payroll, whether it's employee expenses or equity or cash bonuses, and understanding the tax rules that have to get interposed and overlaid through the payroll requirements, that is when the complexity begins to build up. And of course, getting payroll wrong is not acceptable. It's the one thing that will really upset your employees, is if they don't get paid or they don't get paid on time. And although I think payroll is one of the most understated and undervalued functions within an organization, because when it goes wrong, everybody blows up, but getting it right is actually really hard, particularly in the international context. So the sorts of things that you need to consider, obviously, are the regime around income taxes and whether that changes on a cantonal, state, provincial, or city level. So understanding where your employees are working. So, for example, in Canada, there may be different payroll requirements in different provinces. Certainly that's the case in China. Social taxes and social security may be affected by religious affiliation. So, for example, in Germany, there is a church tax that gets imposed if you're a member of one of the religious movements. And other payroll taxes that might hit, for example, I alluded to, for example, equity-based taxes, or other flat taxes that might apply on certain allowances. As I mentioned, I think the key here is understanding that the rules around payroll are not the same as the US. The requirement to remit income taxes on a compliance cycle is going to be different. The treatment and tax treatment of things like company-provided cars, accommodation, share schemes, severance and termination payments particularly, are going to be different in each country. And basically, in all countries, there's going to be penalties and interest charged for failure to comply with the local rules. And what we're seeing is an absolute uptick in the local authorities or the tax authorities auditing foreign companies from a payroll perspective, because they know it's an area where they can make rich pickings. When their budget deficits are down and they need revenue, they will go out and start auditing international companies to make sure that their payroll compliance is completely spot on. Basically, real-time information is a new requirement in the UK. It means that you actually have to be really accurate each payroll month that you're paying salaries. In China, there is individual income tax reporting required real-time in China. So what this is saying is that you can't just leave it to the end of the year or at the end of the quarter and do true-ups and kind of make it come good. Those days are kind of gone. There is a greater intensity around compliance around the payroll function, and clearly you will get reputational damage if you fail to maintain accurate and compliant payroll records in country, which can be damaging and make headline news, particularly if you're a big multinational company. I'd like to thank you all for your time and attention this afternoon. I hope it's been helpful running through those key issues. And I'm now going to hand back to Ernie for some further polling questions.
Okay, thank you very much, Katie, for that compelling content. I'm going to go ahead and launch our second polling question as we start the Q&A. And I'm going to go ahead and start that so we can make use of the great opportunity for questions for Katie. I'll give you some quick questions as we only have a few minutes here. Which countries in the EMEA require documentation in local languages?
Yeah, particularly countries like France and Belgium, Italy. I mean, basically, all Southern European countries will. Countries like Sweden don't require them. But the point is that even in countries like Germany, where you can get away with having an English version contract, if your employee ends up in litigation or in court, then the courts will require local country documentation. So the answer is invariably most countries, and it's something that needs to be checked out.
Okay, great. This question, someone says, I have an employee who currently is working temporarily in the UK. He is reimbursed expenses for housing, home, leave, car, etc. via his expense reports. Are there any issues there?
Yes. Basically, those items are taxable items. Now, depending on sort of if it's a cash allowance, it needs to go through payroll. If it's a reimbursement of rent, it's company-sponsored rent that's paid directly to the landlord or reimbursed, it can be paid through expenses. However, that does require an end-of-year compliance obligation to report the benefit on what's called a Form P11D in the UK. And what we typically find is sometimes those items are paid for directly by the states, and when we come to do the annual filings or the compliance, the US forget that they've paid them, and it gets missed from those expense reporting. So the point is, any payments made to UK-based employees, whether expats or local hires, needs to be accounted for somewhere. It's either through payroll or it's expense reports. If it's expense reports, it needs to be picked up on the end-of-year declaration of employee reimbursements.
Okay, great. Thank you. Next question. If you want to terminate an overseas employee due to having his job function eliminated rather than terminating due to poor performance, would that be cause for termination?
Yes. If somebody's not performing in their role, then that is over time a cause for termination. However, invariably you're going to have to run some sort of due process in accordance with local employment legislation to manage that exit. That would include particularly some sort of series of performance improvement management, i.e. giving the individual the opportunity to improve over time, that those meetings have to be formal and documented, and that even when you come to terminate them, that the dismissal is seen as fair and non-discriminatory. So the answer is yes, it's good reason to terminate someone, but there is always going to be some due process that you need to be mindful of, and make sure that you don't just wade in there and terminate someone under the US concept of employment at will.
Okay, great. Just a question. Say a company has a benefit program during an economic boom and then bust comes, the company has financial pressures. Is there a way for the company to reduce the benefit plan? If so, what is that process?
The answer will depend on what is contractually committed in the employment contracts. And again, I reference back to the point I made about making sure you don't shoot yourself in the feet by putting a too generous benefit provision in and making it subject to change and subject to the company's discretion. So there are ways of ensuring that your employment contracts allow for flexibility, which would then in turn allow for you to change your benefits. However, in many countries, if someone's been receiving benefits over a period of time, they have an acquired right. It's basically through precedent that they are entitled to it. So invariably, you may have to actually buy them out of that entitlement. So again, the answer here is it will depend on how long that provision has been going on, what contractually is obliged, and local legislation, quite frankly. So you may unilaterally have to go into discussions or negotiation with the unions, for example, in certain countries, to be able to agree that.
Okay, great. Thank you very much. I'm going to go ahead and launch our final polling question as we wind down on the Q&A session. Final question for the Q&A is around, could you offer some resources for folks to do some benchmarking by country? That's part one. And part two, if you could give us the top 2 to 3 countries where people seem to have the most problems and expose themselves to the most risk, that would be great.
Yeah, so the answer is High Street Partners does provide what I hope is actually very practical guidance in terms of what are statutory minimums, what are the mandatory benefits that you have to provide in country. That is really looking at the social security regime, and then contrasting that to what may be supplemental or best practice in particular markets or industry sectors. And we do that by looking at the size and the appropriateness of those packages. So for example, Hewlett-Packard or IBM, their benefit program may look very different from a small 3-person IT startup company working in the UK. So just because they work in a certain industry sector, you have to look at the balance and the balance of the compensation, and I referenced earlier on that balance between cash, benefits, and equity, because obviously equity in IBM may not have so much upside as a small entrepreneurial IT company that's going to go through the roof and go IPO. So you have to balance the whole package. So the answer is yes, we do provide benefit benchmarking. We do it not just through buying data from the data off of surveys, but actually through practice and also applying some HR intelligence to looking at the market in which you're working and your current commercial basis. And then the key countries where you need to be very mindful of difficulties, I suppose, and I alluded to them during the presentation. I would say France, Brazil, China, India, and some other southern European countries like Italy, Belgium, although Belgium's not really southern, but it's still problematic, and Spain. Those tend to be the ones that get people. But the Scandinavian countries, although they are a bit more liberal, they have extensive maternity and paternity rights. They have very, very complex holiday entitlements in terms of rollover relief and things. So each country has its own challenges, and I think the key is making sure that you've got complete visibility before you bite the bullet and go into territory, or before you make offers of employment.
Great. Thank you very much, Katie. A big thank you to Katie for your time and insights. Katie's clearly a thought leader in her field and an excellent source of information on today's topic. So note in the post-webinar survey we prompted to take right after the webinar concludes, you have the opportunity to express your interest in being connected with Katie with just a few mouse clicks. Again, a big thank you to today's sponsor, High Street Partners. And then finally, a thank you to the audience for your valuable time. We hope to see you again soon at another performative event or online at www.performative.com. Make the rest of your day great, everyone.
The